Warren Buffett once said, "Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees." Funds are a type of investment that can be a great option for beginners who want to start investing their money but may not have a lot of experience or expertise in the stock market. In simple terms, index funds pool money from many investors to buy a diversified portfolio of stocks or other assets that aim to mirror the performance of a specific market index like the S&P 500. In this video, I will break down how index fund investing works. I will show you why investing in index funds is far much better than stock picking. And finally, I will show you an investment strategy that can make you over $500,000 by investing in index funds with minimum efforts. So before we start, smash the subscribe button. Also, hit the like button as it helps me know that you guys are interested in this kind of videos. What is an index fund? Imagine you want to invest in the stock market, but you're not sure which individual stocks to buy. Your friends have told you that investing in a diverse range of stocks can reduce risk. Your problem is researching and picking individual stocks is time-consuming and risky because you don't know what you're doing. This is where index funds come in. An index fund is like a big basket of stocks that represents a particular market index, such as the S&P 500, which is a collection of the 500 largest publicly traded companies in the United States. So instead of trying to pick individual stocks, you can invest your money in an index fund, and it will automatically buy shares in all the companies that make up that fund. How does index funds work? Let's say you decide to invest $1,000 in an S&P 500 index fund. Your money gets pooled together with money from other investors who also want to invest in the same index fund. The fund manager takes all that money and uses it to buy shares in all 500 companies in the S&P 500 index in the same proportion as they're represented in the index. For example, if Apple makes up 5% of the S&P 500 index, then 5% of your money will be used to buy Apple stock. If Microsoft makes up 4% of the index, then 4% of your money will be used to buy Microsoft stock, and so on for all 500 companies. Index fund investing offers multiple benefits over individual stock investing. Here are some of the benefits of index fund investing. Diversification. By investing in an index fund, you're essentially spreading your investment across hundreds or even thousands of companies. This diversification helps reduce the risk of losing all your money if one company performs poorly. For example, by investing in S&P 500, you are investing in all 500 stocks within this fund. So you are essentially owning stocks such as Apple, Nvidia, and many other best performing stocks. Low-cost index funds typically have lower fees compared to actively managed funds because they don't require as much research or management. This means more of your money stays invested and has the potential to grow over time. Easy to understand. You don't need to be a finance expert to invest in index funds. Once you understand the basics, you can simply choose an index fund that aligns with your investment goals and let it do the rest. Historical performance. Over the long term, many index funds have delivered solid returns that have outperformed the average actively managed fund. While past performance is not indicative of future results, index funds have a track record of success. Finally, let's have a look at one of the best index fund that most people invest in, VTSAX. Created in 1992, Vanguard Total Stock Market Index Fund is one of the best performing index fund. The fund's key attributes are its low costs, broad diversification, and the potential for tax efficiency. The fund is diversified into several sectors such as finance, technology, telecommunications, healthcare, and many others. Unlike many individual stocks, the fund does not have any transaction fees associated with it. Also, compared to other funds, VTSAX is 20 times cheaper to manage, meaning more money for the investor and less money to the fund manager. The fund has over $4 billion in liquidity, showing how stable the fund is. The fund is up 25% since last year with a dividend yield of 1.41%. This is a massive growth. Now let's look at an investment strategy that is best for this fund. We will look at two scenarios. One, if you have enough money in your hands to do a lump sum deposit, and two, if you wish to invest but you do not have a lump sum. This is more ideal for someone who is working a day job and is able to spare a portion of the monthly paycheck for investing. Investing in VTSAX with a lump sum is straightforward. An investor needs to buy a certain number of shares and hold it for several years. Say you invested $100,000 in VTSAX in early 2000. You would have bought a single share for $19. VTSAX is now priced at $126. Your total investment today would have grown to over $600,000. On the other hand, if you did a monthly investment of $500 from 2000 until to date, your portfolio would have grown to over $500,000. On top of these returns, you would be receiving annual dividend of over $8,000. So, although a lump sum investment strategy is great for someone with the capital in hands, the idea of investing a small sum over a long period cannot be overlooked. Index funds are a great investment vehicles due to their low cost and less time required to manage. In the next video, we will look at some of the best ETF that are doing well in the current market. So subscribe and turn on notification. Happy investing and bye for now.